Hello everyone. Thank you for watching this video. Okay, let me introduce myself and my partner. I am Robin. My partner are Nurfiani, Nurlena, Lena Aulana, Iwan and Irwan. We are from Group 2, Capital Gain. We'll talk about book review, The Warren Buffett Way. This video was made on the assignment from Professor Roy Sambel in the IPMI Executive MBA program. The Warren Buffett Way describes what is at its core a simple approach. There are no computer program to learn, no two-inch stick, investment manual to decipher. Whether you are financially able to purchase 10% of a company or merely 100 shares, this book can help you achieve profitable investment return, said Ekstrom, the author of this book. In essence, this book chapters all the learning that Buffett has used and practiced to build his successful investment career. In simple terms, this book has the power to change the mindset of all those who are just beginning with their stock market investments, and even those who are stuck with bad investments and know not what to do and to come out of their troubles. This book, Ekstrom suggests, will assist those investors who are willing to help themselves by doing their thinking, using relatively simple methods, and having the courage of their convictions. This is what the Warren Buffett way is all about. By the way, Buena, do you know who is Warren Buffett?
Yes, of course. He is the world's greatest investor. I have read chapter 1 and 2 of this book.
Yeah, what is your summary book?
Every year, Forbes magazine publishes a list of the 400 richest Americans. The elite 400 of those perennially in the top 5, only one made his fortune through investment savvy. That one person is Warren Buffett.
Tell us about his achievement.
Warren Edward Buffett was born on August 13, 1930 in Omaha, Nebraska. His grandfather owned a grocery store. His father was a local stockbroker. Buffett began a limited investment partnership. He was 25 years old. Over the next 13 years, Buffett compounded money at an annual rate of 29.5%. When Buffett took control of Berkshire, the corporate net worth was $22 million. 40 years later, it has grown to $69 billion. It has long been Buffett's goal to increase the book value of Berkshire Hathaway at a 50% annual rate, well above the return achieved by the average American company.
Bulena, from whom he learned?
Warren Buffett's approach to investing is uniquely his own, yet it rests on the bedrock of philosophy absorbed from four powerful figures: Benjamin Graham, Philip Fisher, John Williams, and Charles Munger. Graham gave Buffett the intellectual basis for investing, the margin of safety, and helped Buffett learn how to master his emotion to take advantage of market fluctuation. Fisher gave Buffett an updated, workable methodology that enabled him to identify good long-term investment and manage a portfolio over the long term, and taught the value of focusing on just a few good companies. William gave him a mathematical model for calculating true value. Munger helped Buffett appreciate the economic return that come from buying and owning great business. The frequent confusion surrounding Buffett investment action is easily understood when we acknowledge that Buffett is the synthesis of all four men.
Wow, interesting, Bulena. And then what is next, Bu?
I am done. Pak Iwan will explain you in the next chapter. Pak Iwan, it is your turn.
Thank you, Bu Lena. Chapter 3 explain about the early day of Berkshire Hathaway with the title Our Main Business is Insurance. In March 1967, Berkshire Hathaway purchased for $8.6 million the outstanding stock of two insurance companies headquartered in Omaha. Buffett's early success in insurance led him to expand aggressively into this group. Over the next decade, he purchased 3 additional insurance companies and organized 5 more. And he has another done. As of 2004, Berkshire owned 38 insurance companies, including 2 giant insurance, the Government Employees Insurance Company atau GEICO and General RA, each of which has several subsidiaries. Continue with chapter 4 with title Buying a Business. All we want is to be in business that we understand, run by people whom we like, and priced attractively relative to their prospect. Warren Buffett criteria are straightforward, a simple, understandable business with consistent earning power, good return on equity, little debt, and good management in place. Warren Buffett is interested in companies in the $5 billion to $20 billion range. The larger, the better. He promised compete confidently and quick response. The strategy of Warren Buffett has turned more and more of his attention to buying companies instead of shares. Buffett is often asked what type of company he will purchase in the future, and he said he buy business, not stock. Business I would be willing to own forever. The most distinguishing trait of Buffett investment philosophy is the clear understanding that by owning share of stock, he owns business, not pieces of paper. The idea of buying stock without understanding the company operating function, like its product and service, labor relation, raw material expense, plant and equipment, capital reinvestment, requirement, inventories, receivable, and needs for working capital in unconsiderable, says Buffett.
And what is his investing guidance?
I will explain about that, Robin. Based on chapter 5 to 9 of this book set, if we go back to time and review all of Buffett purchases, we find a set of basic principles or tenets that help guide his decision. If we extract these tenets and spread them out for a closer look, we see that they naturally group themselves into 4 categories. 1. Business tenet. 3 basic characteristics of the business itself. 2. Management tenet. 3 important qualities that senior manager must display. 3. Financial tenet. 4 critical financial decisions that the company must maintain. 4. Value tenet. 2 interrelated guidelines about the purchase price. In particular, he looked for 3 traits for management tenet. 1. Is management rational? 2. Is management candid with the shareholder? 3. Does management resist the institutional imperative? In evaluating people, you look for 3 qualities: integrity, intelligence, and energy. If you don't have the first, the other 2 will kill you. He relies on a few timeless financial principles. Focus on return on equity, not earning per share. Calculate owner earning to get a true reflection of value. Look for company with high profit margin. For every dollar retained, has the company created at least $1 of market value? And the last investing guideline is value tenet. At that point, any investor must weigh 2 factors. Is this company a good value? And is this a good time to buy it? That is the price favorable? Price and value are not necessarily equal. As a Warren Buffett often remarks, price is what you pay, value is what you get.
Uyani, I think you are different now, bro. You have learned so many lessons from the book.
Thank you, Pak Robin.
Hi, Pak Robin. Why you don't ask me? I have read chapter 9 and 10, the most important part of the book.
Oops, sorry, Pak Irwan. Okay, Pak. Go further, please, Pak.
Buffett is widely regarded as the world's greatest value investor, which means buying stock, bond, and other securities and hold companies for a great deal less than their real worth and waiting until the asset value is realized. So, whether it is blue chip stock or a high yield corporate debt, Buffett applies the same principles. A value investor goes where the deals are. He chooses specific companies with honest, smart manager, and cash-generating product.
How to managing the portfolio?
Well, Pak, every investor knows deciding which stock to buy is only half the story. The other half is the ongoing process of managing the portfolio and learning how to cope with the emotional roller coaster that inevitably accompanies such decisions. Warren Buffett doesn't think in a minute, days, or months, but years. He doesn't need to keep up with hundreds of companies because his investments are focused on just a select few. This approach, which he calls focus investing, greatly simplifies the task of portfolio management. Okay, the focus investor golden rules as follows. 1. Concentrate your investment in outstanding companies run by strong management. 2. Limit yourself to the number of companies you can truly understand. 3. Pick the very best of your good companies and put the bulk of your investment there. 4. Think long term, 5 to 10 years at a minimum. And 5. Volatility happens. Just carry on. Okay, the focus investing big picture are find outstanding companies, less is more, put big bets on high profitability events, be patient, and don't panic over price changes.
Only 2 chapters remain. Ulena, please tell us about the content.
Okay, thank you, Pak Robin. The last 2 chapters of this book is about the psychology of money and the unreasonable man. The psychology of money, it's told about the characteristic of investor and the characteristic of the speculant. The true investor have the calm temperament, patient, and rational, and the speculant have opposite temperament. So the successful focused investor need a certain kind of temperament, the calm, patient, and rational. The road is always bumpy, and knowing the right path to take is often counterintuitive. For the unreasonable man, George Bernard Shaw wrote, "The unreasonable man adapts himself to the world. The unreasonable one persists in trying to adapt the world to himself. Therefore, all progress depends on the unreasonable man." So, when Buffett invests, he sees a business. Most investors see only the stock price. They spend far too much time for and effort for watching, predicting, and anticipating price changes, and far too little time understanding the business they are part owner of. While other professional investors are busy studying capital asset pricing model, beta, and modern portfolio theory. Buffett studies income statement, capital reinvestment requirement, and the cash generating capability of his company. Once a year, he checks several variables: return on beginning shareholder equity, change in operating margin, debt level, and capital expenditure needs. The company cash generating ability if these economy measurements are improving.
He knows the share price over the long term should reflect this. In the Warren Buffett Way books, the first step is more challenging. So if you can already master from first step, the rest of the way is very easy. The step 1 is turn off the stock market. The step 2, don't worry about the economy. Step 3, buy a business, not a stock. And step 4, the last step is manage a portfolio of business. So this is the last chapter of the book of Warren Buffett, Pak Robin.
What an interesting book we are discussing today. The last chapter about afterward managing money, the Warren Buffett way. He looked at the process each manager used to beat the market and isolated 4 attributes that set this group apart from the majority of fund managers. First is portfolio turnover. The second is about portfolio concentration. The third is about investment style. And the last is geographic location. And that is all from us. Thank you, Prof. Roy and IPMI for your guidance to upgrade our knowledge. Thank you. See you in our next video.